Coming.
Everyone online, thanks for coming.
So we got Steve and Tony here to talk about Cost Seg studies with Wipfli. Give me some topic here, so we'll get started.
Hey guys, so my name's Steve. I work for Wipfli. I head up their cost segregation and energy tax and deduction group. Tony's a team member of mine. With that, I'm not a CPA. I'm an architect. Most of our team is engineers or some kind of construction background because of the type of studies that we're doing, with cost segregation and these energy incentives. Do any of you guys even know what cost segregation is? Okay, awesome. So let me go to the next slide here. So cost segregation, the purpose of it is a strategy to maximize your depreciation. Whether it's a single family rental property, a commercial property, industrial property, anybody with real estate can utilize cost segregation. And it could be as simple as a full-blown study or just some consulting. If it's new construction, you own a space, retail space, and you renovate it, you have a lot of costs associated with that. And so sometimes it's just some consulting on how you depreciate those assets. If it's an acquisition, it gets a little more complicated. You have one number, $1 million you bought this building for. How are you going to break that out and maximize depreciation? And that's where we come into play. We kind of help you out, as architects, as appraisers, as whether engineers, how we do that. We go in and we break that building out from the foundation all the way to the roof and everything inside. We place the cost to it, and we allocate it back to your purchase price based on condition, all that stuff. And then we give you that, put in your depreciation. And it's going to be all those assets, whether it's flooring, cabinetry. Another benefit there is you also create a framework for your depreciation. Roof. There's going to be a line item for your roof, for your depreciation. There's maybe your driveway or your garage. And maybe you bought this property and in a year or two, you have to replace those assets. What's going to happen is you're going to put that in your depreciation. And when you replace that asset, you put the new roof in, capitalize it, and then you get to expense the old roof. And you'll have a value because you did a cost segregation study on it. So there's two different values to doing the cost segregation: setting up that framework to have all those assets, and then also accelerating depreciation. Cost segregation can be used for other different things. Sometimes they're used as property tax. Since we're breaking it down almost a cost approach, guys use it as property tax as a reference. They're going to have all this detail. We usually provide a land value where we provide comps on it. For federal tax purposes, we don't want to use the appraiser land value because they're going to want to try to get that marked up. For financial purposes, we want to try to get down for federal tax purposes because it's non-depreciable. So we go in there and do land comps and try to get that land value and get maximize depreciation for you. The other thing is, since you're accelerating those assets, you're creating a massive deduction usually year one, especially with the current tax laws. Anything we move from 20 years to shorter, it's 100% bonus. What does that mean? All those assets get written off year one. So, we move 30% of that $1 million into a shorter bucket, 15, 7, 5 years. You get that $300,000 written off year one. That's your deduction. So that's where increased cash flow comes into play. We've had our studies used as insurance, reduced insurance premiums. Again, we're doing really high level cost approach appraisals on these. So people have used them as a reference to reduced insurance premiums. Transfer tax is a great one too. That one really comes more in play with maybe manufacturing or commercial, where you maybe have a lot of FF&E equipment involved with the acquisition. Maybe you bought this manufacturing as a big boiler and other stuff in. We do cost segregation studies before you close on the project. And again, you're going to have a nice detail of all these assets, including any type of FF&E involved. So then you're able to move some of that stuff into the personal property bucket and not pay transfer tax on that. So there's other ways just to, outside of just accelerating depreciation and how to use our studies. So here, just example, $2 million, somebody buys a building for $2 million. Typically what they're going to do is depreciate that building over 39 years. So for a commercial building, it's going to be 39 years. If it's a residential building, it takes 27 and a half years. And this kind of is what we provide clients, kind of before cost analysis to an after cost analysis, saying, hey, what does that, if we take that, buy that building for $2 million, what does it look like? If we didn't do a cost segregation study, we didn't break all those assets out, what does a cost segregation study look like after it's broken out? So here you kind of see, okay, that $2 million, 39 years. And this is what your benefit every year is going to be, and then after your year one is massive. And that's because you're moving over, essentially 26% of the property into a shorter life, 1575. So you're reducing, you're accelerating all those assets and getting that 100% bonus and that deduction all year one. So your deduction going forward is less, but as a real estate professional and developer, you want to get that deduction down. You can carry it forward if you don't need it. That just increases your cash flow. You can take that dollars, buy another property, and that's a lot of what our real estate clients do. They're kicking that can down the road. Create those losses now. What's up? Sorry.
I got somebody texting me that's on there. If I see the presentation on both screens, the same presentation.
So it looks like this one maybe the arrow.
That one's working.
Oh, I wasn't watching this guy.
Oh,
I was. Okay. I just wasn't hitting hard enough, I don't think.
There we go. Oh,
But this one's good though, right?
yeah, that one's working. Let me do this real quick. Okay, we're good.
Cool. All right. So going back to that, for every property, and any cost segregation group is going to do this for you. If you have a property and you want to explore it, this is free. You just talk to the expert, say, hey, what is that going to look like for me? Can you review this property? Usually all we require is an appraisal and a closing statement. And we come up with these analysis and say, hey, based on this condition of the property, what the personal property is inside of it. Again, personal property for federal tax is going to be a lot different than what you're thinking is going to be flooring, cabinetry, sinks, anything serving a business that may be in there. If it's residential, there's a lot of stuff, ceiling fans, all appliance connections, appliances. So we're going to go in and kind of create that analysis, say, hey, this is what we think if you have cost segregation done, this is what it's probably going to look like. What's up? Yeah, for an acquisition, yes. Well, to create this analysis initially. So if you were going to explore the idea, hey, I don't know if this was going to make sense. Maybe it's a single family rental property. Maybe it's $300,000, and is this going to make sense for me? You contact us or contact anybody that provides cost segregation services. They're going to kind of run this analysis. They're going to look at that based on the appraisal and the closing statement and say, hey, we're going to probably look like 20%. Is going to get moved over to a shorter life. And that kind of gives you and your accountant, when you can provide this, hey, I talked to a cost seg expert, this is what they're thinking they're going to do. Does this make sense for my tax purposes? Is this going to help me out? That's kind of that first stage. You really want to walk through that because you want to make sure if you're going to pay us, X dollars to do something, you want to make sure it's going to actually benefit you on your taxes, right? So that appraisal and then the closing statement, yes, that's going to be the initial start of it. But yes, we'll eventually go through a process of creating the study, visiting the property, things like that.
So correct me if I'm wrong, but it sounds like it's a massive tax write-off, essentially. Yeah.
Yeah. Yes. Correct. Yeah. Yeah. Right now, with the current tax laws, it's used to be utilized by a lot of people because of that, particularly because of the 100% bonus. When you can move everything into a short, that 20 years or shorter, and get that big massive deduction like this, that's everybody's want that, right?
Which is just still a depreciation capture on sale.
Yeah. So yes, good question. Now that's kind of when you're looking at this and you're talking to us, talking to your accountant. what's you're going to buy and sell. Are you going to keep this property? Are you planning on selling it? Usually what I say is if you're going to keep the property 2 or 3 years, it's probably going to make sense. And we can adjust this analysis to kind of reflect that. Like, hey, what does that look like? And what's that recapture going to look like? Absolutely. But sometimes, a lot of the bigger developers look at it as a free loan from the government. They don't care if they're going to sell it the next year because they know they're going to buy and build stuff next year that's just going to kick that can again down the road. So even though they're going to have a big recapture on that property, they're going to be building another property or buying another property that's just going to shield that income as well. So
what about if you buy a building and then you buy an empty warehouse and then you build apartments inside of that warehouse? As you look at your expenses, you already have kind of your line items for what you're putting in. So do you need to do like this? Would this help you still? Because at that point, you kind of did your own analysis by building it.
well, so you have 2 pieces there. You have the acquisition, and maybe there's a parking lot outside. You got the shell, it's a warehouse, maybe it's empty, and then you have your assets coming inside, and you're renovating. You said to apartment building. Okay, so now you have to depreciate that acquisition. Okay, you bought it for $1 million. Well, how are you depreciating that? What's the land value? You want to keep that land value down. You don't want to, have a high land value on that. And then maybe there's assets there. There's probably not a whole lot. You're right. There's probably not a whole lot because it's an empty warehouse. But again, our fees are usually reflected by time and material. So then if there's not a lot of work for us, then you're not paying us a whole lot of money to do it. But then you have the second piece, and depending on how long you held that property, put it in service, there's a whole disposition piece. So if you go in and renovate and maybe move assets and take them out, well, you're depreciating that because you purchased it, and then maybe you put it in service, then you get to dispose of those on your fixed asset and write that off, and then you're putting new assets in service. And then how are you classifying those assets? And maybe that's where consulting comes in. Maybe you have really good invoices. You're working with a really good contractor. He's breaking out electrical, good for you, breaking out mechanical, plumbing, all that good stuff. Maybe it's just us saying, hey, move this into 27.5 years, 15 years, 75 years. Then you're really not paying for a full engineered study. But that's where we are going to guide you and kind of help you say, hey, this is what you need to have done. The other component to it is too, if there's a lot of personal property, you're moving over a lot into a bigger bucket, you're creating more exposure for yourself. So having a study done and having us, because we will defend it for you if it ever goes under audit, you throw me in front of the IRS agent and I'll make it go away. You don't have to worry about it. That comes with us. So we defend all the studies. So, with the new tax laws, 100% bonus, yeah, it's great. But if you get audited down the line and they start kicking stuff back over into a longer life, well, that's going to not be a good scenario. So that's kind of where then we come into play with that consulting, is you want to make sure that that's getting classified correctly.
What you guys do regulated at all, like when it to become a cost?
That's a good question. Hold on, I got a slide somewhere in here. There you go. Expertise matters, right? We are not, and that is a problem within the cost segregation industry. Now, if you guys are real estate professionals, developers, doing real estate, you probably got hammered by some boutique practice that does cost seg. There's a lot of guys out there that probably were selling used cars, 5 months ago an hour, and the cost seg expert. That's really where I encourage you to do due diligence in who you're hiring. Talk to your accountants. They usually have a good reference, whether they use somebody, whether they have somebody in their firm, or they just know somebody. A lot of my clients are referred from other accountants that I have good relationships with. Where I was talking about my background, I'm an architect. A lot of our team members are engineers, commercial appraisers. That's kind of where our background fits into it. We need to know depreciation and then how buildings are constructed and break those buildings out for our clients. We don't need to know all the tax rules on it. And we're in with Wipfli, which has its own guidelines and standards for how we do work as well. But yeah, you're right. You know, there isn't any real hard, you know, at the end of the day, you take those depreciation schedules, you give them to your accountant, they're going to file a tax return. It's that accountant's, you know, basically liability on how that's, you know, taking that work that we're providing. You know, and that kind of goes back to, you know, how the work is being done. You know, some guys are doing it, you know, what I refer to as 10,000, you know, feet up, you know, on Google Earth, looking at your property, you know, just kind of making some assumptions and assuming, okay, it's a single family rental, it's going to have X amount of carpeting, X amount of vinyl. I can see it, you know, on Google Earth and measure out the paving. That's where we encourage, we have to physically inspect the site. The IRS guidelines say that we do, you know, it's not a technical rule, but we go in and we inspect the site and we make sure that the assets that are there, being used the way they are. And we break, you know, and a lot of times you're getting more benefit from that too. You know, there's stuff that you can't just assume. You know, how are those appliances, you know, how many appliances are there? You know, maybe in the kitchen there's appliance connections above the counter. All that's personal property. You know, maybe there's cabinetry in the laundry room. That's more personal property. Maybe there's cabinetry down in the basement. Maybe the basement's finished. Some of the stuff you can't just see, you know, from appraisal or you know, from 10,000 feet up. You know, we go in and actually do a physical inspection. And I kind of talk about it a little bit more going in here. Let me make sure so yeah, and this kind of talks about it right here. So, you know, whether it's an acquisition and new construction are two different approaches. You know, an acquisition, you have that one number. We take that appraisal, that closing statement, and we go physically inspect the property. Because we don't have a lot of data. There's not going to be costs, construction drawings, things like that, typically. New construction is a lot different. You're going to have a lot of data. You have blueprints, you're going to have construction costs. You know, I was just talking with somebody about that. You know, it's with new construction, a lot of times we're encouraging getting us involved in the front end because there's a lot of stuff you can just talk to your contractor and how you break out that stuff. You know, instead of just lumping finishes on your contract, well, what's in that number? What's in finishes? Probably cabinetry, flooring, walls, drywall, whole bunch of stuff. And all of that takes a different asset class. Like if you just took some time and broke it down, well, you don't need to hire me now, and you have a nice clean breakdown. And that's some of the stuff that we can recommend. You know, once we see it, you know, hey, I'm going to do this project. You know, I bought a retail strip. I'm going to build out all these retail spaces. And well, how are you going to do it? Who you're hiring? Let me see a pay application, then I can make some recommendations, and I can tell you whether a cost seg is needed or not. And that's the data that we collect, you know, and then, you know, if we do a full cost seg study, we'll do that full approach where we go into the property and document how those assets are being used. And then at the end, what you'll receive is a full report that covers all the audit and then a set of schedules that are easily, you know, exportable into a depreciation fixed asset system. So you don't need us to be your accountants to do this, you know, but we do encourage working with your accountants because sometimes whatever type of depreciation system they're using, we want to make sure that our work is going to implement into their system well. IRS risk, you know, I get asked this all the time. There really isn't any risk to it, especially with the type of work that we're providing. Where we get audited is really high profile clients. We do all the Green Bay Packers stuff. That's audited every year. It's big pay. You know, really high Fortune 100 companies are audited all the time. That's the work that we're getting audited. It's very rarely where we get an, you know, off audit where a study is coming into play. When that happens, usually what I get is an IDR, information document request, from whether it's internally from our accountants or, you know, externally accountants. And that's just asking some questions about the study, why we classified stuff. I'll answer that, and it's usually gone after that. I have never lost an audit before. I've been through lots of audits. They're pretty straightforward. Really what they're looking for is just what's your methodology, what was your procedure done, and why did you classify these assets? Usually our report covers most of it. You know, if they have additional questions, we have a lot of data on how we calculated all that. You know, we provide that upon request. Where it does sometimes trigger an audit, I guess, would be what we refer to as Form 3115. That's if you're doing a study outside of the year that was placed in service, which you can. You know, we have a lot of guys that strategize around that. So if you do buy a building this year, maybe you're not making a lot of money, you don't need to accelerate a bunch of assets, you don't need to pay me to do that. But next year you are. You can do a study on a look back. So you can kind of poker chip depending on how you want to, how to do that. You know, guys they'll buy a set of buildings in 2018, wait a year, do two of them, and then 2 every year, just to, you know, defer enough tax every year. But that Form 31 is filed with that. When you do a look back, you have to file a Form 31. It's a change in accounting, saying, hey, you classify this property, this $1 million property at 39 years. Now you're going back and you're changing it. And that's where that Form 3115, it gets automatically reviewed by IRS. So it's not an automatic audit, but it can have a slight risk of creating I guess an audit. Okay, fun stuff. Tax cuts and job acts. I won't get too crazy in this stuff. We talked a little bit about this. You know, with that back in 2017, they changed bonus depreciation. Before it was 50%, and it went to 100%. That means, you know, again, anything 20 years or shorter that you classify as an asset for federal tax, you get 100%. There was a great change. The other bigger one that might be, you know, a little more applicable here is the original use. So before that, when you bought a used property, an acquisition, you were not able to take bonus. That was something they changed with this. And that was a big change. You know, instead of, you know, classifying something as 15 years, 75 years, and you just appreciated those over those years, which is still great, now you're able to apply 100% bonus to it. So not only new construction got it, acquisitions got it. That was a big change for a lot of depreciation. Qualified improvement property. I'm not sure how familiar you guys are with this. It's another big change that's, you know, even just happened this year as well. What this was, you know, back in 2017, their intent was QIP was to group what they had: qualified leasehold improvements, qualified restaurant improvements, and qualified retail improvements. They were trying to combine them all together to call them qualified improvement property. You know, each of these had different criterias on how to qualify, and they were trying to make it simplified and better. And with that, they actually ended up screwing it up. And qualified improvement property was for any type of interior construction you did after the fact, after the building was placed in service. So if you bought a commercial property or a warehouse, and you put a business in there, you put a manufacturing business in there, or a retail or something else in there, and you spent all those dollars to improve that property. You know, let's say you bought it for $1 million and spent $1 million to improve it for that business. What their intent was is to make it 15 years qualified improvement property, anything that was interior, non-structural related. And you're with that, with 100% bonus, you're supposed to then be able to write it off all year one. It was intended to help retail, you know, hotels, restaurants, guys that were built or remodeling constantly, you know. And well, with that, they ended up writing it in tax law as 39 years, which then made it ineligible for a bonus. So they screwed it up where then it really wasn't a big benefit for anybody. But with the CARES Act, they fixed it. So this year, now you can go back to anything that you did improvements on that were interior, non-structural related after the building was placed in service, and you're able to take 15 years. So with this, you know, a lot of times guys are like, well, then why do I need a cost seg study done? And a lot of times you don't. If you did an interior improvement, it's all going to go in 15 years, and write it off all year. Why do you need me to tell you that? There's certain situations, because it specifies that it's interior, non-structural, and that means if you're putting windows in, you're reworking the roof, or any type of structural, and your costs are commingled in it, well, that doesn't qualify. And the IRS is looking at this. So if you go in there and say, oh, that $1 million is all 15 years, I'm taking it, boom. But really, maybe $200,000 of it was really structural work. But now, if you get flagged on that, they're going to throw that whole $1 million back to 39 years. So that's kind of where then we come into play and we say, hey, have us look at it. Let's make sure that you're classifying. Maybe it doesn't cost us a fee to do it. Maybe we're just telling you how to do it. Maybe it does have a study with it. You know, we'll tell you. We're not going to try to hammer you on fees, but but at least you want to make sure that it is all 15-year QIP, because you're going to take that all in year one, and it creates, you know, a big exposure for you. This is, I just threw this as an example. You know, if 30, you know, this project, this was actually a real life project. You know, they did $3.5 million improvements, interior improvements that had some structural stuff, which you could see, you know, almost $1 million of structural stuff. But there was quite a bit of QIP. You know, it was $1.6 million. And what that did, you know, instead of them, you know, getting a 2020 deduction of 50,000, you know, they got a deduction of, you know, almost close to 2.6 million. This wasn't even a full study. This was more of a consulting that we did. You know, we saw the pay application, the contractor did, construction drawings. We just took a few hours of our time to engineer out and make sure that, okay, we captured that 28% that was 39 years, you know, for audit purposes. Types of properties that qualify. I mean, we do everything at this point. Our cost point to do stuff, you know, is gone a long way over the last 10 years. You know, we used to not do single families. You know, you go out there, pen and paper, you pay us a bunch of money to do it. Now, you know, go on site with Surface, you know, we can almost print out depreciation schedules before we leave. You know, technology and the way we do stuff has gone a long way. So we do residential properties, single family, you know, whether it's $200,000 to, you know, whatever, hundreds of millions of dollars. So there really isn't any, you know, and I'm always asked, what is the, you know, what price point does it, you know, make sense to do these studies? And it really is just ask us, and we're going to tell you if it doesn't, you know, and we'll show you, well, hey, here's our fee and here's your benefit. And you can make that decision yourself, or and you can, and encourage you talking to your accountant about it as well. Again, typical fee range, you know, $2,500 to $2,000. Even single families, we've done them by like $750 a pop. If they're local, you have a few of them, they're not overcomplicated. I mean, at this point, we've really streamlined a lot of stuff, and we do so many for our internal clients as well. And I think a lot of other cost seg firms are getting to that point as well. Here's just kind of some projects that we've done. You know, this one was 72 single family residential properties, you know, $12 million worth of assets. And we ended up, you know, the year one deduction ended up being $1.8 million deduction with $800,000 net present value savings. And I want to say we charged the guy maybe $25,000 to do it all. He had a bunch of just single families in Arizona. And he's still buying and building them. So, you know, I've got some, I guess maybe some bragging projects in here. You know, we did this one. This is Blue Cross Blue Shield building in Philadelphia. You know, they had renovated all 45 floors. And with that, you know, it was several years for us to do it and for them to do that. You know, they did sections of those floors every year. But at the end of the day, we saved them, you know, $20 million in tax savings. It was insane. But again, a lot of that comes into play with that interior build outs. This is kind of an example of the transfer tax. We had a property, manufacturing property, that had a lot of overhead cranes, boiler systems. And what we did, we were able to get in there before they acquired the building and do the cost seg study. I mean, it was killing two birds with one stone kind of deal. You know, like, hey, they got the cost seg for the depreciation, but then they also got a really nice breakdown for their transfer tax savings. And they ended up, you know, saving more than what they paid for our cost seg in just transfer tax. And then at the end of the day, we got them $710,000 in tax savings. I like throwing this one here. This was for the Coors family. We did a surf park. It was really cool. This is actually in Austin. I surfed on it. It was pretty cool. But so what they did is they built this lagoon, and they have this nice pulley system that goes across that kind of brings their wave system back and forth. And the wave kind of tapers down. So depending on what level of surfer you are at, you know, the higher the wave gets, closer to it. But here it was considered an amusement park, and they weren't going to classify it as an amusement park. But we kind of almost did like a backwards study on it. So amusement parks take a 7-year life. Here where we classified $38 million, 90% of it into that 7-year life. It was almost like I said, backwards study. We were trying to find the longer life assets just to make sure we were accounting for all the dollars. But really cool project. Here's going back to like the, when I refer to tax engineering getting us involved on the front end of construction, again, this is a really high profile project, but it kind of gives you a flavor of what we did for this client. We got on the design stage of the project. And we made, not only did we make recommendations how they were structuring their costs, but we made recommendations on how to structure their assets in the design to maximize depreciation. That's really good for manufacturing, where you have a lot of specialized purpose stuff. Structural steel serving craneways. This had a lot of, it was pharmaceuticals that had coolers, how they were building those walls. We were able to kind of guide them a little bit. Well, if you just did this, you're able to accelerate this in a short life. A lot of it came down to electrical, how they were setting up their panels for the electrical. Instead of mixing their electrical with human comfort electrical, heating, cooling, it was also, separating that heating, cooling for human comfort, but then their equipment had a panel for equipment. Now that whole panel and all the run is personal property. Originally the original design was going to be all mixed together. And it didn't cost anything more to do it. It was just some recommendations. There was a lot of recommendations that we made that just didn't make sense either, just as a construction cost point. And this one was, so this one was a fixed asset review. This was a big manufacturer, never had cost seg studies done. They actually make all of McDonald's chicken nuggets and patties. And they've never done cost seg. And we ended up doing 72 studies for them because we were looked over 10 years. And that's kind of my point of look backs is 10 years is kind of as far back as you want to go for a property. Anything older really doesn't make sense because you've already depreciated 10 years. Here they had projects that were sold, stuff that had been moved or is no longer there. There was what I refer to as ghost assets on the depreciation. So we came up and cleaned up their fixed assets, and they did many studies for any of their acquisitions and projects. I mean, it was really cool. But yeah, at the end of the day, we ended up almost deferring almost all their tax for that year. I think they had like a $28 million tax liability that year. We're right there. Cool. Questions, comments?